Hi, I'm Jamie with A Saving Secret, where I help you be more intentional with your money. If you're new to the channel, please hit the subscribe button. Well, today I want to talk about understanding your taxes well before you get your W-2 form. And in order to do that, let's take a look at your pay stub. So this is an example of some of the information that we found on a pay stub. Some important things to understand about your pay stub is it'll have information determining what you've paid for the pay period and what you've paid year to date. Not everything that you got paid for year to date are you receiving money on in the current pay period. So on your pay stub, they all look different and they all come from your employer. But there's three basic buckets that you need to look at. The first one is your income. Your income will talk through how much money you have made in the current pay period, what you've made year to date. It also goes through, and maybe you've had a bonus or other particular one-time income increases that you want to include. The second piece is on there is your tax information. And on your tax information, there's information like what you've paid for your federal, what you've paid for your state, what you've paid for payroll taxes. Sometimes it'll include that, but it might be broken out to Medicaid and Medicare, but specifically it'll have your taxes on there. The other thing that they'll look at is it'll have deductions. These could be company benefits or things that you take advantage of that you pay out of your salary even before you get it. Some of these information would include your insurance needs. It might also include your retirement savings in a 401k, or if you contribute to an HSA account. These are the three big buckets. So once you're looking at your pay stub, if you notice, it shows you what you've made for the year and what you've made per pay period. If you understand how many pay periods you have remaining, you can figure out the information that's on your W-2 information, which is your AGI. So how do you find this information out? If you know that you have 7 more pay periods for the year, and you're able to multiply that by the current pay period that you've received your income, and you add that to what you've made for the year, that would be your salary. So that's the first place to start. The second one was you would apply the same principle for what you're getting in your deductions as well as for your taxes. Once you have a projected amount for each of these, then you can figure out what is your AGI. Well, how does that work? Well, in your deductions, there are some things that count towards reducing your AGI, and there's some things that do not. So your AGI is your total gross dollar amount money that you make, minus specific deductions. Some of the deductions are included, but not limited to the ones in this example. So if you take what you make minus that, that is your adjusted gross income. Now that you have your projected AGI, let's look how taxes work. Really, there's only 8 steps. You just got your AGI from your current employer, but there could be other forms of income that you have. You're going to want to include it. So once you have all of your income calculated, that is your AGI. Before you start filing your taxes, you want to make sure you have your AGI. But the second piece of information you need to know is what is your filing status? And there are 3 current filing statuses: single, married, or head of household. For the purposes of this video, we'll be showing what it is for married. So once you have your information and you understand that, now you figure out what are your deductions. So some of these deductions that you have captured in your throughout the year. Now the government offers 2 options. You're able to take what's called a standard deduction, or you're able to take an itemized deduction. You want to figure out if your itemized deduction is larger than the standard deduction. If it is, obviously you would take that. If not, you would use your standard deduction. For the purposes of this example, the standard deduction is greater than the itemized, so this is what you'd want to use. So now that you have your gross and you know what your deductions are, you simply subtract the 2. Now that you subtract the 2, this is the amount that is your taxable income. That simple. Now you know what your taxable income is. In order to figure out what you need to pay, this is where you look at the tax table. Let's take a look at the tax table. The information on the tax table shows you the information that you need to know. Looking at it can be a little overwhelming, but basically what they're saying is there are certain levels in which you'll have to pay taxes on. And for each dollar amount that you get to the next level, you'll need to pay an increase in taxes for the next level. To be overly simplified, whether you make $100,000 or $20,000, every single person will pay, if you're married, will pay $1,940. The first $19,400 is taxed at 10%. That is how the progressive tax system works. Then they move up to the next level. So if you're looking at this example, let's look how this taxable income plays out in the example. So if you look at this tax example, this is how the taxes work. The first $19,400 is paid at 10%. After that, you need to figure out what's the difference of the next one. Then you subtract those two, and you now know what you need to pay for this one. Once you've figured that out, then you add those two tax amounts, and that is your total taxable income. You take that taxable income, and that's what you plug into what you owe in taxes. See, taxes really aren't that scary when you really break it down. Now that you know what you owe, there's a thing called credits. Some of these are called child credits. You might have bought solar panels. There's different credits. For the purposes of this example, we'll use the child credit. If you have one child, you would actually put in one child. That means that you get a credit up to $2,000. So you would take what your taxable income is and you would subtract $2,000. This is the money that you're expected to pay to the IRS. Now, you have already paid some money to the IRS. You look at your pay stub and it pulls in, this is what you've paid for the year. Based on our last example, you figured out what your current trajectory is. In this current example, you realize that not only have you paid taxes, you've paid more than you need to pay. So now you look at it and you'll understand if nothing changes when you file your taxes for next year and you were able to get the same income that you were getting from your last pay stub and the future pay stubs, this is your expected amount. If this number is significantly too large, you can reduce what you're contributing to taxes. You fill out what's called a W-4 form with your employer and they're able to make adjustments. Understanding your taxes is extremely important. Taxes do not have to be complicated. Yes, the forms look a little clunky, but really, this is the basic outline of how you pay taxes. Figuring out your AGI does not have to come from your employer after the end of the year. You can have a projection handy that can help you be more prepared for tax season. If you thought this information was helpful, make sure to give this video a thumbs up. If you thought this video would be helpful to another person, please share the video. I'm Jamie with The Saving Secret. Thank you so much for watching and have a great day.